When I usually ask people do they know what mutual funds are, most of the times I get blank faces. But to be honest, they're quite simple. Let me show you how. Hey everyone, welcome to the State of Finance. My name's Abhishek, and in today's video I will show you how mutual funds work. Mutual funds can be known by different names depending upon which country you're based at. For instance, here in Australia, we refer to them as managed funds. But in the end, the principles, they all remain the same. I'll give you an example. Let's say there are three friends, A, B, and C. A has $1,000, B has $4,000, and C has $10,000 available to invest. And yes, they are pretty busy in their professional lives and they do not have the necessary skills as well as the time to track the market. And frankly speaking, this keeps them away and people like us away from entering into the market. So what do? They hire Mr. X. Mr. X is a full-time stock investor. He's a professional in this field. So Mr. X is now hired to manage $15,000. As much as he would want to take his girlfriend on a nice cruise or some fancy holiday, he can't do so because the money belongs to A, B, and C. Also, he has been told not to engage in speculative transactions. So with that money, Mr. X goes ahead and buys certain stocks, say some stocks of Facebook, some stock of Google, and some other banking companies maybe. And that's how he deals with the $15,000. Days go by and ABC were busy in their professional lives. So one fine day, maybe after a year, Mr. X calls A, B, and C and tells them that their holdings, which were initially $15,000, are now worth $17,000. Good news. So ABC now have a $2,000 gain, which they will share in the ratio of their initial investments. But wait, Mr. X needs to get paid. Mr. X gets paid $300, being 2% of the initial $15,000 that he managed. So this was one cute little example of how mutual funds work. But now look at it from the perspective of millions of investors, millions of people who do not have the necessary time and skills to get into the stock market. Mutual funds really make it easy for an average person to get into market indirectly. Now I will show you how the math works. So remember, at the time of initially investing, is $1,000 will be broken down into say 100 units of $10 each, right? So similarly, B will be holding 400 units of $10 each. C similarly will be holding 1,000 units of $10 each. So the point that I'm trying to make is that irrespective of what mutual fund actually invests in our case, it invested in stocks like Google, Facebook, some banks, but the unit holders, the people who have invested in, are concerned with the number of units that they hold, along with the net asset value, which in the initial case was $10 each. Now at the end of the year one, when the net asset value goes up from $15,000 to $17,000 and X is paid $300, the final net asset value now comes out to be $16,700 in total. Dividing that by the total number of units, which is 1,500, gives us $11.1333 per unit. So this is the NAV per unit. So it's pretty much like going to a restaurant and not ordering individual dishes, but instead ordering set menus like vegetarian meal, a non-vegetarian meal, or a vegan meal, all according to your preferences, tastes, and appetite. If done correctly, mutual funds have enjoyed the reputation of yielding high returns. There's an old misconception that mutual funds only invest in equity. These days we see gold mutual funds, real estate mutual funds, debt mutual funds, along with our age-old equity mutual funds. Now that we've discussed the principles of mutual funds, I will tell you what the advantages of mutual funds look like. The first and the foremost is the professional management. So basically, all your hard-earned money and your investments are managed professionally by an expert, by a professional, at a certain amount of fees. The professional also ensures that the money is managed according to the theme of the mutual fund, and it also complies to the various legal compliance. Second would be divisibility. Even a small amount of investment can get you a proportionate ownership in expensive stocks. Remember Mr. A from our example? He only had $1,000 to invest initially. So say if he wanted with that $1,000 to invest in stocks like say Facebook, which at the time of recording this video trades around $1,340, he would not have been able to do so. But now that he has invested in mutual fund, the mutual fund has invested in Facebook, in Google, and other stocks. So now he's a proportionate owner in that expensive stock like Facebook. My next advantage is more in line with the previously mentioned advantage. Even a small amount of investment can let you enter the market. The previous advantage was more to do with the divisibility of shares. Next is diversification. The mutual fund can now, with the pool of money, invest in different shares. So now the risk of putting all your eggs in one basket is drastically reduced. Say if the mutual fund invested in 5 stocks, 2 out of those 5 stocks perform badly, the 3 will kind of offset the bad performance of the first 2 stocks. So the next advantage is for the mutual fund company, or the asset management company as they call them. As the mutual fund companies have access to a large pool of money, they can achieve the economies of scale. This puts them in a better position to carry out research on what stocks to buy, what stocks to hold, and what stocks to sell. And also, they are in a better position to negotiate with the brokers, the bankers, and the other service providers. However, the money in mutual fund comes with some conditions attached to it. For instance, the mutual fund managers can't use the money for their own personal expenditures or for speculative activities, etc. This has to be in line with the objective of the mutual fund. One of the main advantages of mutual funds is the tax deferral. Investors can invest in mutual funds, let their money grow over a period of time, and defer their tax until they redeem the money out of the mutual funds. In majority of countries, the mutual funds are subject to capital gains tax, which is attracted on the redemption of the units. However, it is worth noting that any dividends paid out of the mutual funds can attract income tax depending upon your country of residence. Liquidity. Pulling money out of the mutual funds is very easy. It's actually easier than the conventional investment instruments like real estate and gold. In real estate and gold, you have to find the potential buyer, and the value sometimes cannot be that transparent. So in case of mutual funds, all you have to do is to file a redemption request with the mutual fund company, and typically it takes a few business days to process the request, and the money will flow directly into your bank account. One of the most amazing advantages of mutual funds is that it gives you an exposure to the international markets. For instance, you're living in Australia, but you want to have exposure in stocks like Google, Facebook, Tesla. These are all traded on the US stock exchange. Through mutual funds, you have now what we call as the international funds. These funds allow you to invest in global markets as well. Now coming on to some disadvantages. The first one would be the lack of portfolio customization. We all know that the brokerage agencies can make tailor-made portfolios according to your taste and preference and your risk appetite. Well, if you're looking for that level of customization, maybe mutual funds are not the right investment for you. The pool is usually way too large for an individual investor to have a say over the entire money. So it's highly recommended that you read the investment patterns and objectives of the mutual fund that you are going to invest in and see if that aligns with your investment patterns and your strategy. And the last one is the choice overload. Excess of everything is bad. This may or may not be a disadvantage, These days we have so many mutual funds that the people are actually spoiled by the choices they have. It might get hard sometimes to just find the suitable mutual fund for you. If you can get past these disadvantages, mutual funds actually offer a great platform for individual investors to get exposure to the stock markets. But remember to assess your financial situation, your goals, your timelines, and then your risk appetite. And if necessary, see your financial advisor. So that's pretty much it. I hope you got some value out of my video. If you have some questions, some feedback, some suggestions, please leave them below. And I will see you in the next one. Till then, work smart and invest even smarter. Peace.